Hi everyone, Stacy Whiter here on behalf of Campus Mortgage with a three-part video series on Fannie Mae mortgage insurance comparisons. Now just a quick reminder before we get started, this video is for informational purposes only and should not be considered legal advice or used in place of Fannie Mae guidelines. Also, this video was issued on October 16th, 2018, and the information contained in this video is subject to change without notice. In this three-part series, we're going to take a look at three different ways that MI can be charged to a borrower when they are financing more than 80% loan to value. So the first one that we're going to look at is the monthly premium, then we're going to look at a single premium, and then we're going to look at a split premium. So we'll look at all three of these. But just keep in mind that these are per Fannie Mae requirements, and the examples that we're going to be looking at are for conventional loans, not government loans. So let's first take a look at monthly premium, and this is probably one of the more common ways that MI is charged. So in this scenario, the borrower pays MI as part of their monthly mortgage payment. There's no upfront mortgage insurance premium charged. So like a VA loan and an FHA loan have that upfront mortgage insurance premium. On conventional Fannie Mae loans, for the monthly premium, that would not be the case. A portion of the monthly MI is required at closing for escrow. The max LTV is 97%, but obviously the higher the LTV, the higher the rate of the MI because that's increasing the risk of the mortgage. The monthly premium can be for a purchase or refinance. There's no add-on to the note rate, which is a benefit to the borrower. And after a certain period, once a certain LTV is reached, usually under 80%, the MI will automatically drop off. But of course, the borrower can certainly refinance or pay off the mortgage prior to that. Also, the MI coverage rates are based on the LTV and the MI provider. So this is certainly lender-based, but there are different choices for MI companies, and certainly the lender that the borrower is using is probably going to choose the MI provider, but as you know, there are different MI providers. I do want to show you an example. So let's take a look here at, we'll do kind of a comparison, and we're going to do this through MGIC, which again, this is just an example. They happen to be one of the MI providers, but let's take a look at their website so we can get an idea based on a certain type of loan, what the monthly MI premium would be. So what I've done here is I've simply just gone to www.mgic.com to go to their website, and here we're going to take a look at their MI rates. So we can go here, there's a couple of different ways that you can go to get to the information, but we can go to ordering MI, and then we can scroll down here to the bottom and we'll see a rate finder. And then basically this is going to just bring up a data sheet for you to enter information to get a quote. So let's take a look. Let's say we're going to do a loan amount of $250,000. And let's do an LTV at the highest. So we're going to say we're going to be above 95, but below, at or below 97. Let's use a credit score of 720. And I'm going to pick Georgia as my property state. Let's say we have a debt to income ratio of 45%. We have two borrowers, primary residence, we'll do a fixed rate, a purchase, 30-year fixed. The property type will make detached, a 1 unit. And here we're going to say that we're going to use borrower or borrower paid mortgage insurance. So again, that's the monthly MI. The premium type is going to be monthly, non-refundable, constant, and here you can see this is where MGIC is giving you the coverage amount. So as you can see here, if the LTV, the higher the LTV, the longer the mortgage term, the higher the monthly MI rate. Again, it's just all based on risk. So for this example, we're going to have a monthly a rate of 35% coverage. And then we'll go here, we'll just click submit. And then this just gives us a basic rate quote. So we can see that based on the information that I put in, the borrower's monthly total premium would be based on an initial rate of 0.74%, which makes the monthly MI 154.17, which actually isn't too bad for that high of a loan amount. So that is an example there of monthly MI. And again, there are different MI carriers. I'm just using MGIC as an example. All right, so that concludes part 1 of this 3-part video series. Make sure you check out part 2 and 3, where we're going to talk about single premiums and split premiums. Thanks so much for watching. For more tips and videos, please visit campusmortgage.org to look for their weekly mortgage video tips designed for all mortgage professionals, including underwriters, loan officers, processors, closers, and post-closers. Have a great day. We'll see you next time.